To begin investing, the first thing you need is a brokerage account. A brokerage is not a bank. A bank holds your money. A brokerage lets you buy assets that grow your money. You can download an app on your phone or use your computer to sign up. The process usually takes an hour or two, depending on how comfortable you are with technology. But it's not much harder than opening a bank account. Once you decide to start, you'll see that you have plenty of options, just like choosing a bank. If you live in the US and you want something for beginners, platforms like Fidelity is a good choice. If you want something a little bit more advanced, you can look into interactive brokers as an option. Canadian investors just starting out can use Wealthsimple for zero commissions. If you're willing to learn a little bit more, Questrade is a more advanced alternative. The exact choice doesn't matter nearly as much as starting. You can always open another account later or switch platforms. The goal here is simple. Pick one and move forward. This first step is the hardest for most people, but if you can put in a couple of hours now, you're setting yourself up for long-term wealth. Step 2. Link and fund your account. After opening your brokerage account, link it to your bank so you can transfer money easily. Deposit your first $1,000. It doesn't matter if it's $1,000 today, $250 over 4 weeks, or $100 a week for 10 weeks. The amount matters less than the action. Just get the money in. Funding your account physically separates you from the version of yourself that's been thinking about investing. This is the moment you stop watching and start acting. Pick an amount that doesn't strain your lifestyle or force you to pull out money later. Once the money is invested, you want to leave it alone for years. Step 3. Index funds and ETFs. When you're new to investing, the market feels loud and confusing, and that's done on purpose. Prices move constantly, headlines compete for your attention, and everyone seems convinced they know what's coming next. Most beginners assume this complexity means they're missing something. They're not. The noise exists to rush you into decisions you don't yet understand. That's why your first dollar does not belong in individual stocks, crypto, meme trades, gold, or anything that creates excitement. Excitement feels like progress, but in investing, it usually signals impatience. It pulls you into short-term thinking and emotional decisions, the habits that destroy portfolios early. Your first dollar belongs in an index fund or an ETF. An index fund is a single investment that owns small pieces of many companies at once instead of betting on one. It's designed to track an entire market, like the S&P 500 or the global stock market. So your results follow long-term economic growth, not individual winners and losers. An ETF or exchange traded fund is simply a version of an index fund that trades like a stock, making it easy to buy through a brokerage. For long-term investors, they serve the same purpose. Index funds and ETFs work because they remove complexity. They are diversified by design, low cost, boring on purpose, and proven over decades. They don't depend on your intelligence, timing, or emotions. They depend on time. When you buy an index fund, you're not trying to predict what will win next year. You're accepting a longer truth. Over decades, productive businesses grow, and owning a small piece of all of them beats trying to outguess the market. This is why simplicity matters. Your first investment should be one broad, diversified fund. One decision, one purchase, then you stop. The moment you start comparing multiple funds or strategies, you've turned investing back into a short-term game. The goal isn't optimization, it's consistency. Keep it simple. Your first $1,000 equals one index fund, one click, and you're done. Here's a list of some of the most popular index funds in Canada and the US. And all you have to do is just pick one or two. What you're buying with your first dollar isn't returns. You're buying the ability to stay invested without panic, obsession, or second guessing. You're building the habit of letting time do the work instead of emotion. And that's how long-term wealth starts, not with a big win, but with a decision you can repeat for years. Step 4, the rule that makes you wealthy. Automate everything. What destroys most investing plans isn't the market, it's inconsistency. People don't fail because they choose the wrong investment. They fail because they rely on motivation instead of systems. That's why automation is mandatory, not optional. It's the rule that turns good intention into long-term results. Automation builds wealth. After you've linked your bank account and your first investment is made, automate contributions into the same index fund. Whether it's $50 or $500 a month matters far less than the fact that it happens consistently without you thinking about it. Automation protects you from your future self, the version of you that gets busy, nervous, or tempted to delay. When investing relies on memory or force of habit, it eventually breaks. When it runs on autopilot, it compounds quietly. Most people resist this step of automation because they want the same flexibility as their bank account. But wealth isn't built on flexibility, it's built on commitment. Choose an amount you can maintain, lock it in, and stop negotiating with yourself. The market doesn't reward brilliance, it rewards consistency. You see, once investing becomes automatic, it stops being something you do and it becomes something that just happens. And that's how long-term wealth is built. Now, step 5, wait, do nothing. The hardest part. This is where most people lose, not because the plan stopped working, but because they interfered. You see, once your money is invested and automated, the correct move is to just leave it alone. That's harder than it sounds. People start checking their accounts constantly. They panic during dips, they get excited during spikes, and they feel the urge to do something. Almost all long-term damage happens right here. Let's say you invest $1,000 in an index fund and a month later you check your account and it's down 20%. You see a loss of $200. Your first instinct is to panic. You think this was a mistake and you want out. That reaction is exactly what destroys long-term results. The correct response is to do nothing and keep investing. You leave the money where it is and continue buying every month, just like your system says to. When prices are lower, your contributions buy more shares. Over time, this lowers your average purchase price. When the market eventually recovers, and it always has over the long term, you benefit more, not less. This is called dollar cost averaging. It's not a trick or a shortcut. It's simply the discipline of investing consistently through the highs and the lows instead of trying to time the market. And it's one of the most reliable strategies ever used. The market doesn't punish patience, it punishes interference. Switching funds, chasing trends, or selling out of fear pulls you off course. Most people don't lose money because markets fail. They lose money because they won't sit still long enough for compounding to work. As Warren Buffett once said, no one wants to get rich slowly. That's why almost no one does. Waiting isn't passive, it's discipline. If you can master this step, if you can stay out of the way, you've already separated yourself from most people. At this point, your job isn't to act, it's to let time do the work. And those are the 5 steps that you need to follow to begin investing. Do me a favor and click subscribe. Next, I'm going to talk about what this first $1,000 really does. If you follow this plan, your life doesn't change because the money grows overnight. It changes because you do. This is the moment you stop being the person who says, I'll start later, I need to learn more, or I don't have enough yet, and become the person who acts consistently, even when it feels boring. Your first $1,000 doesn't just start a portfolio, it creates discipline, it creates confidence, it creates a new financial identity. You see, wealth isn't a number you hit one day. It's a system you commit to and repeat. And this first dollar or first $1,000 is where that system begins. The mindset that holds wealth together. Okay, so this is why I didn't tell you to buy Tesla or Apple or Amazon or crypto or the stock that's about to explode. Not because those things never work, but because real wealth isn't built in chaos. It's built in systems, simplicity, and consistency, measured in decades, not days. At this stage, the goal isn't just growth, it's staying in the game. Long-term wealth doesn't come from being right once, it comes from being reasonable for a very long time. Wealthy people don't spend their time watching charts. They design systems that make charts irrelevant. Simple portfolios, automated contributions, and patience replace constant decision making, because overthinking is one of the biggest risks there is. That's the rebuild. You stop trying to win fast and you start trying to last. You stop chasing outcomes and you start protecting the process. And over time, Wealth becomes a byproduct, not the goal. The part most people ignore. If you've made it this far in the video, you're already different. Most people will feel motivated for a moment, then do nothing. They'll scroll, forget, and return to whatever feels comfortable. A few won't. A few will take this seriously, not because the plan is complicated, but because they understand what it represents. This isn't just about investing money. It's about choosing patience over impulse, systems over emotion, and long-term thinking over short-term relief. You don't need perfect timing. You don't need special knowledge. You don't need a big win. You need the discipline to start, the restraint to automate, and the maturity to wait. That's it. And if you can do that consistently, the result isn't just financial growth, it's control over your money, over your time, and eventually over your life. So here's a quick summary. All you gotta do is open up a brokerage account. Then you link your bank account so you can fund it. You invest in a simple, broad index fund. Then you automate contributions so consistency replaces motivation. And then you wait long enough for time to do what emotion never can. This isn't a shortcut, it's a blueprint. And for the few who follow it, it works.